All right, we're looking at the indices for this morning. Upper left-hand corner is the Dow Jones Industrial Average, CFD. The lower left is the S&P 500, CFD, 5-minute chart. And the larger chart to the right is the CFD on the NASDAQ 5-minute chart. I'm going to give you an illustration today of what it's like to be in a market that, admittedly, going in, I already knew that this is going to be a mixed market. And the way you can tell that is by looking at the Dow Jones. You can see that it has not traded as low as the other averages, and it's showing relative strength. Now, I think it's likely to correct a little bit lower today and move in sympathy with the other two averages, making lower lows. And I think it's going to make an attempt to go towards the lows across the averages that was created at the 6 o'clock hour. So in other words, the early morning 6 o'clock New York local time lows for the S&P, I feel that that's likely to be seen as a downside draw. And I believe that the draw on liquidity for the Dow Jones is below those relative equal lows that were formed in the 6 o'clock hour as well. So trading around that 35,680 to 35,640. Okay, so I'm thinking that's where the Dow Jones can go to. The caveat is, because it's showing relative strength here, and it's signifying that it may create a mixed opening for the first few minutes of trading. I'm showing you this is the original account that we've been showing. I've not changed anything. I'm not hiding anything. So the market's just now opened. I want to see a Judas swing rally in Dow Jones because it's showing initial relative strength, and the NASDAQ is tanking here, and S&P hasn't really started moving yet. It's moving up a little bit, but I'm more interested in seeing, does the Dow Jones rally higher? Because that would be a Judas swing. I'm putting an order block in on the NASDAQ on the right-hand side, not for a trade. I'm studying how much of a interest does it want to go lower into that order block. And I'm going to be measuring its willingness to dig into that discount array. And hopefully at the same time it does that, we see a rally in the Dow Jones. And I want to sell short if the rally occurs in Dow Jones. Okay, so we have a nice run into that on NASDAQ order block. And S&P has tore off towards its 6 o'clock low. Okay, and notice that the Dow Jones is not doing so. So now when it does this, I'm anticipating a rally higher. I'm going to put 2.5% risk on this trade. And not yet. I want to see it rally first in the Dow Jones. So notice I have the upper left-hand corner chart highlighted. It has a blue rectangle around it. That means if I open up a trade, it's going to be on that indice, not the NASDAQ and not the S&P. So look at the Dow. See what it's doing? It's failing to go lower. So what that means is it's going to probably run buy-side liquidity. I want to sell when it does that. I don't want to sell short now and try to catch up with the move. And here we have the Judas swing forming on the Dow Jones. And if you look at the high here, and put a little horizontal line on it. There. And boom, there's that first level of buy-side liquidity. My concern is it could really expand up into that second level, and I'm watching. If it does that, then I'll go short. Notice it's against the other two averages. The other two averages are going down. Dow Jones is rallying. My tip-off that it was going to do what it's doing right here and what I was waiting for was the fact that it was already showing relative strength. It didn't want to go lower already, so it was kind of like giving an SMT divergence. It doesn't mean buy to go long. It just means if I'm expected to see a retracement lower on it, then it's going to rally just to give me an opportunity to sell short. So that's how you use the elements of, I am short now. I do not believe it needs to go back up above that buy-side liquidity. So we're going to see if it can reprice aggressively lower on that Dow Jones and kind of like repeat in sympathy what you saw in the NASDAQ and the S&P, which basically for like the S&P, it should take out the low formed at 6 o'clock in the morning on the Dow Jones Industrial Average. The problem is this. Knowing this, it is likely to create a mixed market opening. And it's very, very difficult to trade like that. So I'm going to use this as a hypothetical teaching. Let's assume for a moment that you're doing this trade or something similar to this with a funded account. Okay, say you just went through the processing of doing the initial challenge and now you've been awarded a $10,000 account or whatever the account balance would be. Okay, I'm just using a hypothetical $10,000 account here now just for illustrative purposes. And now you're in a trade, you got profits, it's moving in your favor, and you want to see that short-term low taken out here. I gotta fix this A here. And I don't like it like that, it's gotta go through, right? So now we have the initial objective. I want to see it run down below that, but because the averages are mixed, I want to move my stop to a point of break even. I do not want to be caught off guard because this type of environment could easily see the Dow tear off higher and run out that 35,960 level. But given the initial opening range expectations I had looking at it, they were already signaling there was a mixed opening likely, and Dow Jones was showing relative strength. So because of that, so that way we know each other's thought processes here. Well, I don't know your thought process. I'm assuming you're probably wondering, how did I know it was going to do this Judah swing rally? Because it was showing early signs that it did not want to go, and I'm going to take 6 off here. If it fails to go lower, that's going to be problematic. I'll take something off. If it does break lower, I'll take 6 off below that short-term low I'm looking for. But it needs to start showing me that it wants to go lower. Like it should already, in my opinion, it should already be dropping. So this is early signs of trouble for me, because the trade should be offering low resistance liquidity run signatures and just delivering lower prices and expanding lower, taking out that 6 o'clock in the morning low. It's not doing so, so I'm going to take a partial off here. I'm going to fund the position so that way if it runs against me and stops me out, I've been funded for this particular trade. I didn't waste mental capital. I didn't waste my time being in it while I had profit. I took profit. And it's in the scope of my typical, what I look for 50 to 75 pips a week in Forex. This was in the range of 50 to 75 handles in an average. So I've already met that criteria right away with the first partial. And notice that it did not even hit my first profit objective. So this is where I teach being profitable while wrong. Okay? I'm not technically right. Even though the market has moved from my entry, if I don't take something off the trade, I'm not profitable. Okay? So you have to find ways to be profitable and not focus on being right. Okay? Being right would be seeing it trade below that low. And now because it's not doing so and it's stalling, my concern is with this mixed opening, I want to study how does it dig in below that low. Is it sharp and fall off cascading with large ranges? Or is it just subtly going down below it? That's problematic. Or if it fails to go lower, that's also problematic, because that means that the probabilities for this particular trade is far less likely. Okay, so the early signs of this move here, yes, it was showing me its hand that it wanted to produce a Judah swing on the upside, and this is a balanced price range in here. And I'm thinking that right there, that's a decent area to anticipate the market stalling, and it should, in all other instances, it should decline from there and then take out that short-term low. That's what I'm thinking. That's what I'm expecting watching it. Now, that little wick on that candle that just closed, if you measure that 50% point, that's consequent encroachment, that also should be on this candle here. It should not go higher than that. Okay, so I'm anticipating a swing high forming, and this candle's high should stop at or very close to the consequent encroachment of the highest candle that formed just to the left of it. So because it's a balanced price range too, because the big beefy candle that I sold into, that one is the buy side, and then the most large down close candle on the Dow, that's the sell side offer. So that's a balanced price range in there. I'm looking at the other indices. They're still mixed. They're off their lows, but it just looks sloppy. So the more I look at this, the more I'm concerned that, and I'm going to mark that consequent encroachment on that wick, I'm just eyeballing it. Okay, so you can take a look at it from your data and measure how close that was. But I'm showing you real time as I was recording it what my expectations are. Now I want to see it sell off from here. Okay, and if it did that, then I'm okay. In my mind, I'm thinking, okay, I'm on side, I'm trusting it, and I'm going to be looking for a swing objective. The swing objective would be a measurement from the Judas swing high and where it started. So there's sell stops resting below there that I want to see it tag into. And if it does, I'll take 3 of them off there. And I'm actually encouraged at this point. I'm watching it. But once it starts this type of movement, it needs to follow through. It can't be lackadaisical. It can't be lethargic. It can't just, well, you know, just hang out in this range a little bit more. You don't want to see that, because then you start burning mental capital. And as soon as you start burning mental capital, the internal dialogue inside of your mind while you're looking at this trade, or a trade similar like this, your expectations would be, okay, I'm going to take something off here because it's stalling. I want to see it move in my favor. But if it does, and it moves in my favor and breaks below that low, I'm looking at this objective here. Okay, so 35,677. And let's get that on the right level. And then if it breaks below that, 35,640, I like. And if you look at the 5-minute chart on the Dow Jones, right now we're looking at a 1-minute chart. But the 5-minute chart, if you zoom out, you'll see a 5-minute chart candlestick with a tail, and measure that out, and you'll get the middle point of 35,643. I'm just liking the idea of 640 because it's a round number. Now I'm looking at that right there. That should break down, and it should already be cascading lower and running into target. That's what should have already happened by now. And notice it's not doing it. That to me signifies that we are in a mixed opening. I'm probably going to be caught up in a trading range environment that's going to be distorted by time. It's just going to mark time going sideways. I do not want to be in that position if it does that. At least not the position open as much as I have here. So I'm going to be looking to lower the stop. In other words, I'm going to lock in a little bit more in case it moves against me. So I pay myself more for the time I invested into this. And I'm going to be looking to take something off because it's stalling. It's stagnant. It should have already delivered below those lows. See how it's just sitting around like that? Going sideways. I'm burning a lot of mental capital by watching this because I already know I'm in a mixed opening between all 3 averages. If you get into a trade like that, and if it's like a Forex trade and you start seeing the dollar index start doing something, you know, to this effect, and they're not agreeing with one another, like obviously for a Forex trade, you want to see the dollar index moving opposed direction from the euro and cable, and you want to be on side, obviously, if you're short cable or short euro. But they all should be agreeing with one another. If the dollar's going higher, you should be seeing lower prices in both euro and cable. If you start seeing one of them not do that, that creates lower probabilities for your trade, and or deeper retracements likely. And that's what this is looking like to me. So my concern is, yes, I've lowered the stop now, and I locked in a little bit less than 40 pips, or 40 handles. So now what I want to do is determine how many of the 5 remaining open I have, and I'm going to peel off because I don't like the fact that it's stalling like it is. So I'm going to make one more check of the indices, and the NASDAQ and S&P are rallying off their lows. So I'm going to right now take 3 of them off. And now I've completely reduced the amount of mental capital being expended here because I've paid myself for the trade through hypothetical, paper trade obviously, but from a conceptual idea, what I'm showing here is because the market's stalling too much during a mixed opening environment, it makes the trade less likely to deliver with high probability, low resistance. And while the opening being mixed before I got in the trade was illustrated, and I've focused your attention on the market that was going to rally, which was the Dow, and what was my thought process as why it would rally and create a Judas swing. My concern is I don't want it to trade back up close to my entry at all, because to do so is not good money management. It's not good trade management. It's either going to give me the opportunity to take something off in this range here or break to my objectives, which is what I'm looking for. But it's showing this right here is bad. That I don't want to see that. So I already know I'm going to get stopped. So I know I'm going to get stopped out here, and I've already committed to a full stop out on the balance or second target being hit. So I'm just for the purpose of illustrating it, because you can see it here typed out, I'm allowing the stop. Now you could close the trade here and keep the extra $100, $98 or whatever it is, and be done with it. But I'm going to let the trade stop out, because I want you to see that the ideas that I had in mind, what I was afraid of in terms of not seeing, I shouldn't say the word afraid of, but what I was concerned about is that the trade would fail based on the things I'm showing here. So there's the stop out. So by itself, this transaction was profitable. Was I correct? No. And this is what I mean by you have to find a gray area in your trading where you're not focusing on being right. You have to focus on being profitable and preserving mental and real equity. So effective trade management 101 is, if the market is not delivering, you need to take something off. Always look to reduce or remove risk quickly. Now, if the markets are starting to move on a liquid basis where it's real smooth running right when you get in your trades and it starts taking off towards your objectives, that's something entirely different. Then you don't have to worry about being so aggressive about taking things off or removing the risk or lowering your stops or adjusting your stops. But in this environment, I'm going to show you the account here. Okay, so let's show you where we took profits and such. Before I did this, the account balance was $11,073.22. So what I'm going to do is I'm going to enter the balance right now after this stop out on the balance, which was in profit, $11,704, hypothetical, minus the original balance prior to this day's trades, which was $11,073, which was a gain of $631. Then you divide that by your original balance, which was $11,073. That gives you 5.6% gain on a trade that I was wrong about. Think about that. Let that sink in now. For a trade that I was wrong about, I put myself in a situation where the markets were mixed, where it's highly likely that it's going to be difficult for it to move in my favor. And then I'm showing you how you manage in those environments. Did this trade equate to being right? No, it did not. It did not even go to my first profit objective. But I managed the position in a way that allows me to not suffer drawdown. Now, I'm not suggesting it by any means that this is the way that you completely remove any likelihood of losing, because I'm going to do these enough times that you're going to see me lose on a trade. All right, folks. Hopefully you guys got something from that trade execution and trade management idea. I wanted to use something today because I noticed that the stock indices were mixed, and you don't want to typically trade like that. But if you ever get caught in a situation where maybe you didn't see something as clean as you thought you did, or it transitions into a mixed environment, that's how you trade your way out of that. Okay, these are the types of things you do. You do not hold on to like an arm wrestling match and think, I have to get my first objective or I'm a failure. That's toxic thinking. That is not what a consistently profitable trader thinks like. We have objectives, which are goals. Those goals are just suggested exit points. The market is in control whether or not it trades there or not. You are not. I am not. We cannot bend the markets to our will. We cannot make the markets subject to our desires. We have to stay in alignment with the market. Okay, so while later on after the trade pans out a little bit more with more consolidation, the delivery goes to the levels I was looking for, but the other averages were going the other direction too. So how do you log that? How would you go in and log that? You would just go in and observe the things that you were concerned about if it was your trade. The things that you observed that were important, that signified and gave you confirmation that we're likely to see stagnation and the market not move in your favor. You don't want to be in trades that take a lot of time to unfold. Okay. And when I say that, obviously, if you're a position trader or a short-term trader, you're going to have to submit to time. But intraday trading, you want to have opportunities. Once you enter, you don't want to see it hanging around too much. Okay. Day trading effectively and consistently is when you see that you're on side rather quickly. That's what you're looking for. You do not want to see a market spending a lot of time in consolidation after you enter, because the more time it does that, the more mental capital you're going to spend, and it becomes a hope and a prayer. You lose all objectivity, and then it becomes a religious trade, and you start asking God to help you out. And while I believe personally that God's still in the miracle business, I don't think he's looking to try to be a trading partner, okay? Because believe me, I've invited him many times over almost 30 years. And while I think he saved me a few times, for the most part, he just let me endure to the pain threshold that carved me into who I am today. So long story short, you don't want to be in these painful, long holds where it doesn't move in your favor. Even if it trades to your objectives or where you thought it was going to much later in the day or the following day, don't look at that and say, I failed. Don't look at that and say, oh, see, it did it and I just didn't hold on to the trade the right way. You're going to see if you do these types of things and manage your trade the way I've taught in that example, you're going to see that it is going to serve you better by doing that than worrying about the few times that it ends up going where you thought it was going to go. So I'm in an area in the house where you're going to probably hear my dog barking, and I'm not going to be editing out because I'm short on time today because we're getting closer to the holidays and we have to do some shopping and such, so in preparation for our family getting together. So, but anyway, I went into that with the idea that some of you are going to go the funded account route, and maybe you're trying to get a $10,000 threshold account. And that's kind of like hypothetically what I set up here with the paper trade account. So at $10,000, I've already shown like 17%. So 17% gain on essentially like 3 trades. So they're not home runs either. Like I'm not hitting home runs. I'm not doing a lot of leverage. I'm not doing a lot of trades. I'm just going in once a week and I'm trying to find something that makes sense. Okay, that's all I'm trying to do. And I'm trying to build it up so that way if you can make 10, 15, maybe even 20% a return. Now, I'm assuming that the folks that are hearing me talk like this understand that they have gone through a full year of mentorship here. They have figured out what model they want to work with. They've practiced for 6 months with it. They found consistency in paper trading and in demo. Then once they feel confident that they want to go into something like a funded account, which I'm not telling you to do that. I'm not telling you to go out to pick any particular company. I'm not affiliated with any of them. I don't get paid for it. I have no vested interest in it. I'm just answering the requests of students that said, could you show us how, if you were doing this, how could you do it where if we come into certain situations, like what would be the challenges and how would you overcome those challenges? That's what I'm trying to do. Obviously, you hear me discuss in the recording that I've already looked at the averages that you saw on the screen live when I was recording it. And they were mixed. So that mixed opening sets the stage for a very hard, less likely to see low resistance liquidity run signatures appear in the market. I waited for the one that was showing relative strength to rally. So I picked the one that was going to go up first just to sell short. I was not trying to buy anything. I wasn't trying to trade the NASDAQ. I wasn't trying to trade the S&P. The foresight is the proof in I was looking for what I was looking for. Okay, that's the takeaway. I already knew it was going to be a mixed day. I already knew it was going to be a mixed opening. And I'm trying to push your imagination into an area where if you have yet to be in a trade or environment like that where it becomes problematic for your trade to be panning out, how do you engage the market? How do you manage yourself? How do you manage the position so that way it doesn't turn into an outright loser? Now, it's not, again, a reminder, it's not a recipe to remove all losses, because if I do this enough times, which is kind of like the goal here, if I do it enough times, eventually I'm going to get a trade that I'm wrong on. Okay? And even if I have to force that, I will. But I want you to see that if you're in control of yourself, you don't have to hit home runs to do well. And if you can build your ability up to be consistent about what it is you're trying to do and remove all these Olympic style objectives, I want to make $1 million off my account. I want to flip my account 100% every month. Put that aside. I'm not saying don't aim for that over time, okay, if that's what you want to do. But everybody that came through here, and I'm talking to the group from 2016, like, you need to start with humble beginnings and let those be the foundation, because 17% without having a lot of leverage, without capturing a big move on any one of the trades, and even this one was wrong. I didn't even get my first profit objective, but I was still able to add on 5.6%. That is what consistent, profitable traders focus on. They are not focusing on being right. They are not forcing and twisting and doing Brazilian jiu-jitsu with these candlesticks to bend and contort them to make them go to where they want them to go so they can go show it on social media. They're balancing their bottom line. And they're managing the psychology and the emotions while in between the trades and while they're in the trades. And you have to be flexible enough to see what the market's telling you when you get into a trade. What is it communicating? Because if you keep telling yourself, if I just hold on to it, it's going to go where I want it to go, that is myopic thinking. And it's going to lead to toxic thinking when your trade's paying out as losers. And then you're going to think poorly about yourself or the methods or the concepts or your model. And you're going to want to likely abandon the things that you're doing that get you to the results you're looking for. Everybody's results in the beginning are going to be less than they aspire for the end result. So if it's a consistently profitable trader is what you're aiming for, you're not going to be consistent in the beginning. It's going to be sporadic, okay? And I'm going to try to pantomime that as best as I can within reason, but still teach you conceptually what you would do in certain situations. Now, obviously, I went in today picking a very difficult type of trading environment for trading indices. Very, very difficult. I don't believe any of you in here, even from the 2016 group, would have enough understanding to know which one of those three indices was going to create a Judas swing to rally to go short on. I'm confident because I've never taught it. Today, I kind of taught it. So you had a lot given to you in those, 18, 20 minutes of commentary over that trade execution and in trade management. The main takeaway is not that I added 5.6%. That's not the big thing. The big thing is I was not able to get my first profit objective, and I was still able to add to the account in any degree while being wrong. If you can gravitate towards that in your trading, over time, you will be in this game long enough to let the tools and yourself develop in trusting them. You will get the wins that pay a lot more than these instances where even when you're wrong, you can still add a little bit on. You will take losing trades. You are going to suffer drawdown. It will absolutely happen. But you have to understand how to manage yourself and not lose your mind about it. And also, even though I saw two other instances where the averages were allowing me to get in and get the objectives I was looking for, I did not go back in. That's also what you need to be reminding yourself. If you get out by the skin of your teeth and you say, okay, it didn't work out for me, it was a little bit harder than I thought, markets aren't really trading in tandem, the averages are not in agreement, they're not moving together. So what does that tell you? Does that mean go in and gamble? Does that mean go in and plunk down 5% and try to get more money because, hey, 5.6% isn't enough for one day? It is plenty enough, okay? But you don't want to go back in and press your luck. You don't want to go back in and press your luck. But I'm going to go through this analysis real quick because I want to talk a little bit about the institutional order flow entry drill and then close this video because it's already long. All right, dollar index has slipped a little bit today, and if it drops a little bit more, watch this area in here. That, to me, is the last line in the sand for buyers. I don't think that, if we go below that, it's good for the longer term. I mentioned that it would probably be bearish if we close on the rejection block, or below it rather. And on the hourly chart on the dollar index, you can see we had a failure. This is the S&T divergence I mentioned on the dollar index. It failed to get above its high, where the euro was able to make a run below its low. Straight up inside of the bearish order block here and sells off. I'm not sure if it's going to run completely down into that, so I'm not trying to make any case for that at all. I'm just noting that I mentioned yesterday we had an S&T divergence bearish, so you know what that means. It's probably going to have a retracement, and we're still trading inside the range for the dollar. 15-minute time frame dollar index. Again, you can see the bearish order block trades up into that there, and just breaks lower consistently. Trading lower. This right here, consequent encroachment of that wick. That right there is really nice. Study that on a 1-minute chart. 1 and 5 minute chart. That's a really nice one for that run right there. Not that you're trading the dollar, but it's good. Euro dollar daily chart. All right, here's where we did not want to see this. We did not want to see it close above the rejection block here. The market traded down into the order block here yesterday, and then we just rallied up from that. So it looks like we may be gravitating towards this imbalance, and we'll see what we get in regards to that on Thursday. Hourly chart, euro dollar. Again, trading into the bullish order block on the daily chart. That's that dashed line here. Rallied up. Judas swing there. And then rallied up. And we have a small little portion of imbalance right there. That might be the next upside objective. And then the buy side there. 15-minute time frame, euro dollar. Just a real nice run higher. This has been a, if I'm not mistaken, I think it's a bank holiday. If I remember correctly on the economic calendar, it's a bank holiday for euro, and they're running it against that. So thin markets create these types of opportunities. Pound, again, expanded lower, just really nice run below its relative equal lows here on the hourly chart, and the old daily low formed on last week's dealing range. Ran through that, and then we're back up in here rebalancing. I like this area here and the consequent correction of this wick. So if we get continuation on the upside, focus there. And 15-minute time frame, nothing real too exciting there. Everything I mentioned on the hourly is more important. All right, quickly, this is the area I wanted to talk about, and we'll close the video out. I'm going to be doing this with all the PD arrays. I said we'd go back into it again. All right, so the ICT institutional order flow entry drill. On the left-hand side, this is when the market is bearish. This little triangle at the bottom of it just signifies that there was a high formed, and all we're doing is focusing on the candles when it was going up, where there's a gap, and then we have another gap right here. If we trade up into that, this is a balanced price range. Institutional order flow entry drill would be expected in this instance for sell. In other words, not likely to see it completely fill in. When the market's bullish, same thing here. The market went down, created some short-term low. We don't care about the low. We're just watching the market go higher again, where we have a gap over here and another gap matching it like that. That's a balanced price range. If it trades back down into that, right below or at that candle's low, that's a buy for institutional order flow. That's when you would expect to see it when this balanced range formation occurs. Another instance is when we're expecting bullish prices and you see the market create a short-term swing high and then trades down and creates a short-term low. And again, that triangle area is just, I'm trying to keep your attention on the areas that constitute a institutional order flow entry drill. I don't want to have extra candles up here to this swing high. I don't want to show you any number of candles that go down to create some kind of short-term low. That is the variables that can be all kinds of different examples of what that would look like. But when we're looking at when the market's bullish and we had a recent swing high that's traded through, and then we have a gap here, okay? If we trade back down into this gap to this candle's low or below it by a little bit, but not closing in, that makes it an institutional order flow entry drill. Why should that be expected when it has this swing high in here? This candle has a wick on it, so consequent encroachment. That should be supporting price too. That also makes a case that this shouldn't completely close in on this candle's high here. So institutional order flow entry drill would be expected bullish buy at that candle's low or just below it, not closing in this entire imbalance because of the old high here. So the idea is the market's bullish. It rallied from some level down here. We don't care. That's not important. See, most of the things that you guys do when you're training with me and looking at charts, you're looking at way more chart candlesticks than you need to be. I'm trying to take you in, like, for instance, think of, not that I'm an advocate of going out and killing animals, but I guess if I was hungry enough, I would do it. But imagine you're a hunter, okay, and I hand you your rifle, and you have a scope on it. We're walking towards the edge of the forest, okay, and then you're looking out there and you see all these trees, and I point out a deer. You may or may not see the deer very clearly, but you're looking at it, and you say, okay, I see it. But you're focusing in on that animal in the panoramic view of the entire landscape in front of you. That's what you want to be training your eye when you're looking at these charts. You don't want to just look at everything and oh, there's a squirrel over there. Oh, look at that. There's a gopher and a groundhog running over here. And look at this. There's a snake right by your foot. Well, maybe you should be looking for that. That's your stop out. You're getting stopped out, or a margin call. All right. So if we're looking at candlesticks and you're looking at way more than you should be, it's going to be difficult for you to learn because you're trying to take in more information that's not necessary. So my idea here is that we're bullish. The market's shown a willingness to want to rally. How many candles did it go up? Or how many periods did it go up before it creates this swing high? It's irrelevant. Okay? Once it creates this swing high and it trades back down to some swing low, how low does it go before it makes that swing low? It's irrelevant. Okay? Once we trade through this swing high and it's rallying and we have a gap here, this gap is not a fair value gap because it has this wick in it. So this range high to the close, or I'm sorry, the open of this candle, that wick, midpoint is consequent encroachment. If you extend it out in time, that's right here. So this next candle or some candle in the future, if it trades down to that candle's low or below it, we would not reasonably expect to see this range completely close in, which makes it institutional order flow entry drill. Why does it not want to likely close? Because this candle's wick is a gap, and it acts the same way that a balanced price range would be, because on the previous one, see how we have this? This is a gap, and this is a gap. So we have gap up, gap down, both balancing this area. Buy side delivery, sell side delivery. Okay, so if it's going to gap through and then gap down back through it, that's a balanced price range. It does not mean it can't come back up into it completely and close it in and go deeper against your institutional order flow entry drill entry. That's always likely. It's not highly probable, but it's likely. So that's why your stop isn't just, oh, let's put a stop right here at the top of that and call it even. No, your stop would have to be above this candle. Okay, or maybe even using the opening. The body of that candle would protect below all this area here. Could eventually rather close that in. That's the one caveat to this pattern. So when you're using institutional order flow entry drill, you have to use proper stop management and allow for a little bit more of a drawdown. Whereas when we talk about fair value gaps, you can be a little bit more specific and precise about where your stops are, and they can be smaller. Institutional order flow entry drill, you're going to see a lot more entries and opportunities using this pattern than fair value gap. Fair value gap, when they're there, they're nice, but they themselves don't always have to fill in completely too. So there's some caveats with that as well, and we'll get into that one. But the difference is we have this gap here and the gap down here. This same gap is being illustrated with this. That's how I teach the wicks and the tails on the candlesticks. They are gaps because the market's opening on this candle, running up hypothetically, because I made this candle myself. It opens, rallies up. Right in there, that's a gap. The market runs for liquidity and then gives up that entire range and goes lower. So from the opening price to the high, that is a gap. And if that overlaps with this gap over here, this makes this a candidate for institutional order flow entry drill as a buy. If it touches that candle's low right there, the very next candle or some candle in the future, it doesn't matter. How much time? Why do you think you learned about the data ranges? The look back and the cast forward. So you have 20, 40, and 60. Those ranges could eventually be used for that to come back and trade back into it. Now, if you're using lower time frame charts, you're probably not going to be anticipating a 1 minute or a 5 minute chart 60 days later trading back down to it. Likelihood is probably the same day or same trading session, it'll trade back down into that and give you an opportunity to run with it if the market is indeed bullish. Opposite is seen with institutional order flow. When it's bearish, the market is likely to go lower. It creates a short-term low, rallies up to some short-term high or intermediate-term high. How far, how long did it take to get there? It doesn't matter. This is just indicating that it created some kind of a high between this period and this period here in price action. So if we see the market trading lower off of a short-term high or intermediate-term high, and it's trading lower and it creates a gap here, and that overlaps rather with a candlestick's tail like that. This is a gap. Consequent encroachment would be right here, extend that out in time. The market, if it trades up to this candlestick here high or a little bit above it, you could sell short there. That would be your entry pattern, getting short with institutional order flow entry drill, with the expectation that it would not likely completely close in this gap because we are up against this over here. So to the left of these gaps, the classification for institutional order flow entry drill versus the common fair value gap, this is the characteristics I'm looking for to differentiate it and how I would trade them respectively. So if this were not the case, okay, and this was not having the gap shown with this candlestick's tail, this would probably be a fair value gap. But because it has this like this, if it trades up to this candlestick's high or just above it, I would look to go short, and the stop would be at that candle's open or this high here. And I would use that as my defined range. And how you know if you should be taking that entry, because you don't just look at it and say, oh, I'm going to get short here, put my stop loss and see what happens. You don't want that. You want to see, okay, if you're getting in at this candlestick's high on institutional order flow entry drill, and your stop is this opening, how many pips or handles, if you're trading indices, how much of a range is that? And does it offer you from that point of entry 3, 5, or more? Then you're forcing yourself to execute in high probability conditions. If you trade less than that, and I'm not saying you can't, you can do 1 for 1 for real, but while you're learning to develop into consistently profitable, in the beginning, it's okay to do 1 to 1 because you're going to get a lot of opportunities to practice, and you're not hopefully looking at that to okay, I'm profitable because I did this profitably. No, you're forcing yourself to get in there to execute and see and read the tape. Reading the tape, studying, that's what you should be doing for a long time. Okay? The first 12 months, you're doing mainly that. You're not demo trading. You're reading the tape. You're studying. Does the moves consistently come like I outline them, how I teach them? If you see this setup here where you're trying to go short, assuming that's the case, and you're using institutional order flow entry drill as your means of entry, your stop has to be on this candle here, the open or the high. Now, if this is a bullish candle, you would use the close or the high. But you want to be above the body's volume. You don't want to be anywhere near the inside here because, again, institutional order flow entry drill can sometimes expand up to and close in and retap that same level there. And if your stop loss is in close proximity to that, it'll take you out of it. And then it's just very demoralizing to see it come and start running in your favor, and you probably won't want to get back into it. And it's probably better if you didn't because you don't want to be chasing price. But if you can find a opportunity like this and you frame that risk from where you try to get in at where your stop loss should be, and you gravitate towards working with a lot of setups, practicing and reading the tape with 1 to 1, then trying to force 1 to 2 as the only objectives for your studies, and then try to force only 3 to 1. And what do I mean by that? If this is, say, 20 pips of risk, try to find setups that allow for, if it does this setup as an entry and you're bearish, you're risking 20. Does this move have the opportunity to pay out 60 pips lower from your entry? And that will be 3 to 1 gearing. And that gearing is like really good because with 3 to 1, you can weather a lot of mistakes. And eventually, if you can transition to only looking for setups that offer 5 to 1, then you have really matured as a technical analyst and a trader because you know what you're looking for. You know how to frame it. 5 to 1, man, that pays for a lot of errors. And if you're controlled and you're responsible with yourself, you're not over trading, you're not over leveraging, you're not putting too much risk on through your equity, you're not taking more trades than you should by frequency. So you're not over trading, you're not trying to do more than you should. You're not getting all caught up in the gambling aspect of it. You're looking for transactions that make sense. And now you're incorporating 5-to-1 with it. Well, man, now you're well-rounded because you have a lot of experience behind you. And let's just say the trade works out that it doesn't really yield 5-to-1, even though you framed it in a way where 5-to-1 is what you're looking for. You're taking partials along the way. So if you take partials off at 2-to-1, and then again off at 3-to-1, and one off at 4-to-1, and you hold for the balance at 5-to-1, are you really technically getting 5-to-1? No. But are you adding to your balance and your bottom line? Yes. And you're managing fear and greed and your emotions until you get to the point where you can see and spot setups that do the 5-to-1 more likely, and you know what they look like. Because in the beginning, you don't know what a 5-to-1 looks like. You don't know how to engage a 5-to-1 because you haven't done it. But you have to do these things over a period of time. This is why I tell you all the time, it takes more time than you want it to. You can't watch my videos, you can't read a book, you can't go to somebody's seminar, and you can't buy some kind of application or system that's going to make this easier for you. It is not going to be easier. It's not going to be faster, and it's not going to be easier. It takes growing pains to get through it. But it's worth it. And you need to learn to have fun while you're doing it because you're growing. You're growing as an analyst, you're growing as a technician, and you're growing as an independent thinker, which is the outcome that all of you should aspire to. That is the result of doing the things I'm teaching you to do. Not relying on ICT, not relying on what I tell you in the commentaries. You will be able to go in these charts any time frame and say, there's a setup right there, and this is what it's going to do. And then you engage, and then if it delivers, you cannot imagine the sense of confidence, the feeling of victory that you have because you found something on your own, you framed it based on the logic that I'm teaching you, and you understand why you're doing it. You're not confused about it. You're not asking yourself, is this really a fair value gap or is it institutional order flow entry drill? Which one is it? You know now what an institutional order flow entry drill is. These are the very simple things to define it visually. Now, your homework is to go in and find 5 examples of it. I do not want you sending them to me, okay? Don't email me them because there's too many of you. You're going to clog my email address up, and I won't probably respond to you anyway because there's too many of you doing it. You know, based on what I'm showing you here, if it matches this and it delivers price as I'm outlining here, you know that's an example of it, okay? An additional homework assignment and study that would amplify this, you want to be looking at these in the kill zones, but then look for times where they are not forming inside of areas that are not kill zone, and you'll see that they're not likely to deliver like this, which is why I teach you kill zones. Okay, with that, I hope you found this insightful, and so I'll talk to you tomorrow. Be safe.